Hello everyone. In this particular problem, what we're going to do is we're going to go through adjusting journal entries. So what we have here is we have a company, Ken Hensley Enterprises. They're a small recording studio in St. Louis. Rock bands use the studio to mix high-quality demo recordings distributed to talent agents. New clients are required to pay in advance for studio services. Bands with established credit are billed for studio services at the end of the month. Adjusting entries are performed on a monthly basis. So as you can see, we are starting with what is known as an unadjusted trial balance. And so basically what has happened up to this point is we've gone through the regular normal monthly recurring journal entries, and from there we prepared an unadjusted trial balance after posting all of the journal entry activity to the individual ledgers. So with the updated ledger balances or running balances, we are given this, what you see on your screen right now, the unadjusted trial balance. Now the next step in the accounting process is to take this unadjusted trial balance and go through an adjustment process. What you're going to see that there are a lot of accounts that need adjusting at the end of the year or at the end of the accounting period, in this case monthly. And it's just required because you don't capture this activity in the normal recurring journal entries during the year. So once again, here's our unadjusted trial balance, and we have been given certain transactions, and you can see the other data here. We are given 9 other pieces of data that what we need to decide to do with, if there's an adjustment or not, no adjustment necessary. And so let's go through this. So let's take number 1. It says records show that $5,280 in studio revenue had not yet been billed or recorded as of December 31st. So after analyzing all of our activity for the month, we realized, you know what? There have been $5,280 worth of revenue that we earned, meaning we basically gave our recording studio to certain rock bands for use for their recording, but we haven't billed those rock bands yet. So obviously that is something that needs to be recorded in December. This is revenue that is earned in December, so it needs to be recorded in December. So the adjusting journal entry, and we can see it down here, over here, December 31, we're going to record our revenue, and revenues get recorded with credits. And we're just billing our customers, so we're not collecting cash. So we'll increase this asset called account receivable. Okay, next, number 2. Studio supplies on hand at December 31st amounted to $8,280. Well, if I come up here to my unadjusted trial balance, do y'all see there's an asset called studio supplies of $9,120. But at the end of the year, if I count only $8,280 of supplies in the supply closet and my trial balance is $9,120, guess what? I got to reduce the $9,120 down to $8,280. The difference is an expense, and that's $840. So we'll reduce our asset, and we will do so with a credit of $840, and the difference is an expense. So we'll recognize the expense. Expenses are always debited. Next, we've got number 3. On August the 1st, the studio purchased a 6-month insurance policy for $1,800. The entire premium was originally debited to an asset account called unexpired insurance. And you can see here, there's an asset called unexpired insurance. Now let's do the math. If there was $1,800, it was the premium for a 6-month policy. If y'all do the math with me, 1,800 divided by 6, that works out to what? $300 a month, right? If you take 300 times 6, there's your $1,800. So basically what we're saying is $300 a month is going to expire. So after August, September, October, and November, that means $1,200, 4 months at $300. $1,200 of the $1,800 have expired. And what happened? they went to an account called insurance expense. And so we have $600 remaining in the asset. Well, what we have to do for December is December's insurance, or $300, needs to be reduced from this asset. I will do so by increasing the insurance expense with a debit, and the credit is going to go to the unexpired insurance. This is an asset. After we post that, the balance is going to be down to $300. Okay, next, number 4. The studio is located in a rented building. On November 1st of year 1, the studio paid $7,200 rent in advance for November, December, and January. The entire amount was debited to prepaid studio rent. So we have an asset here, let me highlight it, called prepaid studio rent. And we paid 3 months of rent in advance. We paid $7,200 for 3 months worth of rent. If you take $7,200 divided by 3 months, you get $2,400 a month. So this prepaid rent, basically what's going to happen is this asset is going to, what we need to do is we need to reduce it by $2,400 a month. So for the month of December, we will do so. And here's your journal entry. You can see it here. We're going to reduce the asset prepaid studio rent by $2,400. It is now an expense. It's no longer an asset because the month has expired. Time has gone by. It's expired. Okay, next, number 5. The useful life of the studio's recording equipment is estimated to be 5 years or 60 months. And remember, we're doing monthly adjustments. So we need to convert the 5 years into months, which is 60 months. Okay, well, if we look at the asset called recording equipment, that was purchased for $108,000. All right, that asset has a finite life. According to our estimates, it's got a 60-month life. So if I take the $108,000 and I divide it by 60, that works out to $1,800. And so every month what we need to do is we need to depreciate this equipment by $1,800. And your journal entry, and you can see it here, we will increase this expense called depreciation expense. But instead of crediting the studio equipment directly, we're going to credit what's known as a contra asset. And this contra asset is called accumulated depreciation. Let me just show you up here. We have the recording equipment and its contra, which is right underneath it. And the reason it's called a contra asset, for those of you that speak Spanish, the word contra means against or opposite. So if the asset has a debit balance, a contra asset is going to have a credit balance. And these two account balances that are highlighted, we're going to show the net debit between these two as the number of the balance on the balance sheet, as our net book value of our equipment. Okay, number 6. On May 1st of year 1, the studio borrowed $19,200 by signing a 12-month 9% note payable to First Federal Bank of St. Louis. The entire $19,200 plus 12 months interest is due in full on April 30th of year 2. So basically what's happening is we've got this loan for $19,200, and let me highlight it here in the trial balance so you can see it. That's a liability, and it's going to remain a liability until we pay it next April. But loans are not free. We have to pay an additional interest amount on top of this principal amount. And the way you figure out interest is as follows. There's a formula. And the formula is as follows. It's you take your principal, and in this case it was, how much was it? $19,200. And you multiply it by the interest rate, which in this case is 9%. So I'll take the $19,200. I will multiply it times 0.09, which is the decimal 0.09 represents 9%. And that gives us a number, $1,728. You know what that $1,728 represents? That represents interest for a full year. But we only need 1 month's worth of interest. So if I take that amount and divide it by 12, I get $144. And that is going to be an expense incurred for the month of December. And so we can see here we're going to increase our interest expense for $144, and it's a liability. We're not paying it today, so I will increase or credit my liability called interest payable. Okay, very good. So let's take a look at number 7. Number 7 shows records show that $4,320 of cash receipts originally recorded as unearned revenue has been earned. So we have this account here called unearned revenue. I'm highlighting it here so you can see it. Unearned revenue is a liability. Students usually better understand this liability account by calling it customer deposit. And so what's happening is some rock bands have paid us, the studio, in advance before we actually gave them the use of the recording studio. That customer deposit, or that payment in advance from our customers, that is a liability. We haven't earned it yet until we provided the service. So what's going on here in number 7, it shows, of this amount of $11,520, according to our records, $4,320 of this we've earned. Basically, we've now provided the studio to these bands. So what we're going to do is we're going to reduce this liability, and we will do so with a debit, and we've earned our money. So now is the time that we can actually record the revenue, and we will do so with a credit. Okay, number 8. Salaries earned by recording technicians that remain unpaid at the end of the year amounted to $648. So we have this account here, or $648. This represents earnings. Our technicians earn that money. They came to work. All right, that's an incurred expense. Even though we're not going to pay them until the next month, we need to record the expense in December. And so we will do so by recording this expense with a debit, and the credit is going to go to a liability account called salaries payable. And last but not least, number 9, the studio's accountant estimates that income taxes expense for the entire year ended December 31st is $23,520. So basically what we're saying is we need to make sure that we have a liability called income tax payable. So we have a line item here, income tax payable, $3,840, and we have a expense, called income tax expense, $21,480. And what we need to do is we said we estimate that the expense for the entire year is $23,520. Well, we've already recorded an expense of $21,480. The difference, or $2,040, is the additional expense. So we will record the additional expense with a debit, and we're going to credit the liability. And of course, when we make payments to the IRS, that liability will be decreased. These are adjusting entries. This is a required part of the accounting cycle. After these adjusting entries are posted to the ledger accounts, we now have an adjusted trial balance. And from that adjusted trial balance, we can now prepare financial statements. So now I am assuming we went through the adjustment process after all of the adjusting entries were recorded and then posted to the ledgers. And from the adjusted trial balance, we can now prepare our financial statements. The first financial statement is called an income statement. And so Here's an income statement. An income statement is for a period of time. So this is for the entire year. The entire year ended December 31. We've got revenues for the year, less all of our expenses, all right, and the difference between the revenues minus the expenses is net income. Or it could be net loss if the expenses are greater than the revenues. That is the first of 3 financial statements. And this will be discussed more in the next chapter.